I asked for a good family fight, and I got one. That's Kevin Warsh, in his own words, describing his second meeting as Fed chair. 9-3. And every single one of those 3 dissents wanted to move in the opposite direction everybody expected.
Wait, opposite how? I thought the entire point of picking Warsh in the first place was to get rate cuts moving. That was the whole pitch to the White House.
That was the pitch. From Trek for Wealth, this is the podcast. I'm Grant.
I'm Avery, and today we're checking in on a story we started back in episode 21, the day Powell walked out and Kevin Warsh walked in.
And the day his nomination alone was enough to help crater the silver market, which we covered in episode 39.
Right, so this is genuinely the actual payoff episode we've been building toward this whole time. What has he done since he actually got the job, now that the confirmation drama is old news?
Let's get into it. Quick recap for anyone just joining us. Jerome Powell stepped down in May. Kevin Warsh, a known inflation hawk from his earlier years on the Fed board, got the nomination partly because he'd softened his tone enough to sound like a rate cutter to the White House.
And our take back then was basically, don't trust the forecast. That nobody, including the analysts getting paid to know this stuff, could actually tell us with confidence what a new chair would do once he had the gavel.
Our exact wealth move was, don't trade the chair. Analyst predictions about a new Fed chair have missed by triple digits historically, so let's see how that's held up.
May 22nd, he's sworn in. And here's a detail I didn't expect. Powell actually stays on the board afterward as a regular governor. The guy who got pushed out is still sitting in the room.
June 17th, Warsh's first meeting as chair. Unanimous vote to hold rates at 3.5 to 3.75%. But the real news wasn't the number.
Okay, so what was it if the rate itself didn't actually move? What am I missing about that first meeting?
He shortened the policy statement, dropped forward guidance entirely, and didn't submit his own personal rate projection to the dot plot. He called it regime change. Reporters started calling his statements curt.
So meeting 1 is basically a quiet non-event on paper, but underneath it, a total change in how the Fed even talks to the public.
Exactly. Meeting 2 is where it gets loud. July 29th, same decision on paper, hold rates steady, but the vote was 9-3.
Okay, who were the 3 specifically, and what did they actually want instead? Because dissent can mean a lot of different things.
3 regional Fed presidents, Beth Hammack from Cleveland, Neil Kashkari from Minneapolis, Lori Logan from Dallas. All 3 wanted a quarter-point hike. Not a smaller cut, not wait and see, an actual increase.
A hike? The guy got the job because he was supposed to be the rate cutter.
And that's the whole story in one sentence. This was the first time since September of 2016 that 3 policymakers dissented with a completely unified view on which direction to move.
So somewhere out there, someone's paycheck bought less again this month than it did a year ago. And the people arguing about how to fix that can't even agree in the same room.
It gets even more interesting. This morning, literally the day we're recording this, the Fed released the minutes from that July meeting.
Today? What did they say?
That the hawkish mood in the room went well past just the 3 dissenters. The minutes quote officials saying policy tightening would likely be necessary if inflation doesn't decline, and that current financial conditions might not even be tight enough to get inflation back to target.
So walk me through why. What's actually driving this?
Inflation. July's numbers came in at 3.4% annually, down slightly from June's 3.5%, but still well above the Fed's 2% target, where it's basically lived for over 5 years now. A lot of that is energy. Gasoline prices are up something like 25% from a year ago, tangled up with the on-again, off-again conflict with Iran.
That's the direct link back to episode 23.
Exact same story, still playing out. Meanwhile, real wages, pay adjusted for inflation, have actually fallen for 4 straight months. People's paychecks are losing the race against prices.
But isn't the job market supposed to argue for the opposite? For a cut?
That's the other half of the tension. July's jobs report showed payrolls actually shrank, not just slowed. And the two prior months got revised down by over 100,000 jobs combined. Unemployment ticked up to 4.1%.
So you've got a labor market that looks like it's practically begging for a cut, and inflation plus energy prices that look like they're begging for a hike, both happening at the exact same moment, pulling the same committee in opposite directions.
Which is precisely why this isn't settled yet, and precisely why Warsh has been playing for time instead of picking a side fast. He's launched task forces on inflation measurement, on AI's effect on productivity, even on how often the Fed should hold press conferences. He's floated cutting them from 8 meetings a year down to 6.
That's a real structural change, not just talk.
It's classic Warsh. Build the case slowly. Don't box yourself in with a promise you can't keep.
Can we sit with that wage number for a second? Falling behind inflation for 4 straight months. What does that actually look like for a regular household, not just as a headline stat?
It means the same paycheck buys a little less every single month, quietly, in a way that doesn't show up as one dramatic hit. It shows up as groceries costing more, gas costing more, and a raise that technically happened but didn't actually keep up. That's the part that doesn't make headlines the way a Fed vote does, but it's the part people actually feel.
Okay, let's actually steelman both sides here, because I don't think this is as simple as hawks bad, doves good. What's the strongest case for actually hiking in September?
The Hawks case is straightforward. Inflation has been above target for half a decade. If the Fed holds again while prices stay hot, it risks looking like it's lost control of the number it's supposed to be defending. And once people stop believing the Fed can hit 2%, that belief itself becomes a problem, because expectations start driving prices on their own.
And the case against? For actually cutting, or at least holding steady longer?
The labor data. A shrinking payroll number plus a 100,000 job downward revision isn't noise. It's a trend starting to show up in real time. Hike into a softening job market, and you risk turning a slowdown into an actual recession, which is exactly the kind of move that gets remembered for decades.
So neither side is being reckless. They're both looking at real data and reaching completely opposite conclusions.
That's the most honest way to put it. And it's also exactly why nobody, including the people in that room, can tell you with confidence what September looks like.
Okay, so where does all of this leave someone actually listening to this in August, trying to plan their own money around whatever ends up happening in September?
Let's get into the moves. Move 1. Don't front-run the September meeting. 9 committee members held in July. 3 didn't. Even the people voting don't agree yet, so don't act like you know something they don't.
What about anyone who assumed rate cuts were basically guaranteed this year?
Move 2. Revisit any borrowing decision you made banking on that. If you delayed refinancing something or took on a variable rate loan expecting lower rates by fall, that math may no longer hold.
What should people actually be watching, if not just the headline Fed decision?
Move 3. The 10-year Treasury yield, not the Fed funds rate, is still what actually drives mortgage and long-term borrowing costs. That's been true since episode 3, and it's still true now, hike or no hike.
Remind people why that gap matters, because I think a lot of listeners assume those two numbers move together automatically.
They don't, and that's the trap. The Fed sets a short-term rate directly. The 10-year is set by the bond market itself, pricing in inflation expectations, growth expectations, and how much it trusts the Fed to actually hit its target over the next decade. The Fed could hold steady in September, and mortgage rates could still climb if the bond market decides it doesn't like what it's hearing.
And with real wages already falling behind prices for 4 months straight?
Move 4. Prioritize your cash buffer over anything fancy right now. An emergency fund matters more in a stretch where paychecks are quietly losing ground than in a stretch where everything feels calm.
And the gold and tips allocation you told people to add back in episode 21?
Move 5. Keep it. That move was built exactly for a moment like this one. Genuine uncertainty about who's actually in control of the next 12 months of policy. Nothing about the last 3 months should make you abandon it. If anything, it's the one call from that episode that's aged the best.
So, honest scorecard. Did Don't Trade the Chair hold up?
Almost perfectly. And not in a comfortable way. Nobody, not us, not most of Wall Street, had the rate cutter's own committee leans toward a hike within 90 days on their bingo card.
Preparing without predicting, right? We're not calling September.
Not even close to calling it. The history of a new Fed chair's first move is really the history of everyone assuming they know which direction someone will lean, right up until the actual vote count says otherwise. Preparing without predicting. Always.
That's Trek for Wealth. Keep trekking.